Welcome to Cup of Joe. I'm Joe Gallimore, Director of Investment Management with Arjit Bridge Advisors. Today, I want to talk about headlines and a little bit of market history. So every Monday, I give a brief to our team about what's going on in the capital markets. And it seems that for the past 2 months or so, I've been flip-flopping back and forth with good news, then bad news over and over again. And this last week, I used the term manic market because it seems like the direction of stocks and bonds week to week right now is being driven by the headlines du jour, whatever's being talked about in that particular week. To start the year, it was the Fed's going to cut interest rates a lot. Now it's, well, the Fed's not going to cut interest rates anymore. Then war broke out in the Middle East. Then the focus shifts to earnings. NVIDIA, it missed its earnings. Oh, wait, but Apple and Amazon, they beat their earnings. Declining inflation has stalled out. Wait, but the jobs numbers, they're really strong. So, it's all that kind of stuff. And coming later this year, there's a big presidential election. And along the way, there's bound to be more debates over the debt limit at some point. And who knows what else. We can certainly expect something unexpected. So the truth is, this stuff is nothing new, and it never ends, as I'm sure we all know. But my goal this month is to offer you some perspective on headlines and how they relate to the stock market. So I found a wonderful chart that came from our great investment partners at First Trust. And what this chart shows you is the growth of the S&P 500 index from 1970. And the pattern is obvious. The US stock market grew a lot in the past 53 years. $10,000 invested without any fees or taxes, invested in the S&P 500 in 1970, that grew to about 2.6 million at the end of March here in 2024. But what this chart illustrates is many of the notable events that happened over time. And each of these was, I'm pretty sure, a big headline at the time, and they probably felt very major while it was going on. So will you take a couple minutes to read through some of these and reminisce? I'm going to highlight some other truths about this window of time. First is taxes. Taxes, starting in about 1965, which is 5 years before this chart went, all the way up until 1981, this shaded area, the top marginal tax rate was 70%. That's something that's almost unthinkable to young people this day and age. So there was a very high tax headwind for savers and earners. The next is something we're very familiar with, interest rates. The Fed spent the last 2 years increasing interest rates from almost zero up to 5%, where they've been since last June. But most people forget that interest rates were above 5% from 1972 to about 1991. That is almost 20 years. And look what the market did in that time. It went up almost about 8 times with some significant drawdowns along the way, including Black Monday, the largest single day stock decline in market history. The last thing I'll mention is price declines. Price corrections. Price corrections, the technical definition of a price correction is when is a 10% decline in the index level. Now, on average, those happen about once every 22 months. So usually, we don't even make it 2 years without a bumpy drawdown. And you can see that this chart clearly illustrates the bumps along the way when the market experiences price corrections. Now, if you're wondering about full-fledged recessions, since World War II, there have been 12 recessions in the US. And in the period of this chart, since 1970, there have been 8 recessions. So in both those time periods, that turns out to an average of about 1 recession every 6.5 years. So even if those recessions lead to sustained market drawdowns that last, a little longer than the average, the market always finds a way to recover up. So taking this chart in as a whole, the chart, it does include some bad moments in history. There's a couple terrorist attacks in there. There's several mentions of war. Hurricane Katrina is mentioned in here. But it also contains many good moments. There's the birth of the personal computer. There's the fall of the Berlin Wall. And I'm sure what will be everyone's favorite, there's the invention of the iPhone. But the point is that the market perseveres through all these headlines and ups and downs. Now, if you're sitting there and you have a sense that things are just fine and we're just chugging along and you're thinking, Joe, why are you bringing all this up? Well, if that's the case, then please don't let me worry you, because you are absolutely right. Things are fine. Equity markets are positive. US GDP is growing. That's positive. The unemployment rate is still really low. It's just that right now we're experiencing a lot of mixed signals that I'm sure you're seeing on television, and that the stock market is certainly giving you the impression of. And these mixed signals can be very confusing and very unsettling for investors. But the point is that the headlines, they just cause short-term movements. 2023, that was a great year for the stock market. The S&P 500 was up 26% that year, but it wasn't a straight line from January to December. You remember Silicon Valley Bank? That was about 1 year ago right now. And also, when stock prices advance a lot, they tend to take a breather. And that's what we saw in the market in April. The market took a breather. So think of all these headlines as tea leaves. And don't look at any of them as the one thing that's going to change everything, because it's not. And history has proven that. And as we say repeatedly here on Cup of Joe and in your review meetings with your advisors, staying invested is the most important thing you can do. So thank you for watching. Please like this video if you found what we shared today valuable. And always feel free to reach out to us with any questions you have about anything. Thank you very much.